Hey traders, this is Blake Morrow with Forex Analytics, and you're listening to the week ahead video for July 9th, 2023. I hope you guys all had a great week, and I hope you rocked it on the non-farm payroll yesterday. What a crazy day. You think you're in the summer doldrums, and then all of a sudden you get, this non-farm payroll gives us a lot of volatility. Next week we're going to have CPI, so make sure that if you are planning that summer holiday time away, stick around for at least another few more weeks, and we'll talk about the reasons why. And actually, I want to start off just really quick today. I want to talk a little bit about that jobs data because we'll just go back and look at the calendar right here. You can see that the jobs, the payrolls came in below expectations. First time we've actually missed below expectations in a while. But at first, the markets really responded and they really rallied. And what the interesting thing about that is if you look at the average hourly earnings right above here, you can see it right here. The average hourly earnings went up, and it's interesting that the market responded the way that it did, at least initially. So I was talking to Jim Welsh from Macro Tides. If you don't listen to that interview every week, you should. It's right over here. You can go to tradersummit.net. It actually happens to be playing. It was a pop-out playing, but you can see it's located right here. Here's Jim. He gives a good macro overview of the markets every week with me hosting. But we were talking about it yesterday, and he, thought, hey, the markets, even though the inflation data is strong, the market feels that these stronger employment numbers are helping the economy skirt a recession or a very bad recession. I found was interesting. I think the market's a little bit more concerned about inflation. Hence, next week is going to be a very big deal as we go into next week. But Jim also believes that this continued strength in the labor reports gives you that gives the market that, or the economy that Goldilocks feeling, I guess, if you will. But it's interesting, by the end of the day, we reversed pretty aggressively. So we're going to talk about that, and we're going to talk about so much more today. What I want to do is I'll go into the charts. You could go into the live charts with me on Forex Analytics if you want. I'm going to actually go through them on the bigger charts here because I want you guys to get a really good view of what I'm talking about. And the first thing I wanted to discuss today as we move into this is I want to talk about this move in yields, and I want to talk about how crazy it is. Take a look at the 10-year yield. We're well above 4% right now. We're approaching really key resistance. The 30-year is one that we've got to be watching because it is actually just trying to break out. You can see we actually closed it in breakout territory, or really damn close to. And if you look at the actual bonds, I'm going to take a look at the bond market, and I want to show you some technicals here in a second regarding that. But before I do that, look at yields, not just in the U.S. Take a look at the yields in Canada. Here's the Canadian 10-year. Here's the Aussie 10-year. Now Japan 10 years, yield curve control. So you're going to see these yields pretty much capped. But look at between boons, gilts, just you name it. You got yields just ripping, right? Here's German 10 years, even Italian 10 years have a little bit more oomph. Look at the Eurozone 10 year. I mean, you can see these yields are really starting to pop across the board. The reason why this is a big deal is because as yields move, you got to think about, how's the market going to take this information and take this move higher in rates across the board. And I think it's going to be, at some point, you're going to start to see it weigh heavily on the equity markets. But I want to talk about, as we go into the week ahead, let's talk about the 10-year. Let me pull up the 10-year really quick bond market. I want to show you how important this support is. You saw it in yields, but you can also see that we hit the 161% extension and horizontal support. This is really kind of do or die for the 10-year. If we start to see a breakout or a breakdown in bonds and a breakout in the 10-year yield, you're going to see probably a very big response from the market, more than likely from the dollar itself. And I'm going to talk about that here in just a few minutes. But before we get into all these other charts, And we're going to start off really talking about what the market's expecting going into next week. I do have to mention that next week we have a ton of Fed speakers. We have Monday, we have Barr, Daly, Mester, Bostic. Tuesday, we got Bullard, Fed, or Wednesday, we got Fed's Kashikari, Bostic, Mester again, or is it Mester again? And then Thursday is Waller. Earnings week starts this next week, and CPI is obviously going to be the headliner on Tuesday. All right, so let's let's go back to our charts that we've been using here on the week ahead video, and I'm going to have to do a little bit of deleting here and getting caught up on everything that we're seeing. So first and foremost, let's delete all this with the euro. What you're going to notice in the euro is we are consolidating in what I consider a pretty big triangle. All right. Now we're threatening an upside break, which means dollar weakness. But if yields continue to rally, the dollar might start to strengthen, especially if you saw that reversal pattern that we saw in the equity markets on Friday. That could set up for a little bit of dollar firmness moving into the early parts of next week. So before you get too bullish the euro, thinking that we're going to clear 110, I think 110 is possible. And the stops around here, especially in some thin liquidity coming into the early week. But I'm going to see how the euro responds on a closing basis around this 110 level going into next week. You know, before I even continue to move on, I need to say thank you. I forgot to say thank you, and thank you to Gregor Horvat, and also, let me go home here, Gregor Horvat, and for the very first time, we had Ryan Littlestone do the week ahead videos. So if you guys don't follow our team, actually on Twitter, you should, but you'll see that Gregor Horvat's right here. Make sure you follow him. He did the week ahead video 2 weeks ago. Ryan Littlestone did it last week. He's also the host of the Flow Show every single day that we do. He's located on Twitter right here. Make sure you follow not just those two guys, but the rest of our team on Twitter as well. And no, we did not move over to Threads. I know some of you did. And I think you'll find most people moving back to Twitter for right now. Anyway, let's get back into the charts. So another chart I want to talk about, not just the euro here. Oh, by the way, let's get a little bit more granular as far as the analysis goes with the euro. Okay, so here's your trend line resistance. A lot of horizontal resistance all the way through here. If we do break above 110, we get a solid break above 110. We should challenge the highs. That would be a given. But like I said, with inflation data coming in this next week, you got to be a little hesitant doing that ahead of Wednesday, because Wednesday is the CPI data. But let's take also a look at the Aussie dollar. The Aussie, and I'm going to delete things here really quick, and I want to show you kind of following a bear flag pattern. This is what it looks like. But the bear flag pattern kind of got nullified on Friday because of this move higher that you saw in the Aussie. But the way I'm still looking at it is this could be a wedge pattern, which makes sense, and here's the thing you have to think about with the Aussie dollar. The Aussie dollar should be responding well with equity markets near their 2023 highs. It's not. And, it is a risk appetite tool, the Aussie is. But because China has kind of fallen flat on its face for its reopening, and even though they're doing some efforts, taking efforts to put some easing into their economy, it hasn't really helped the Aussie at all. Now on Sunday night, we have China's CPI, so just keep that in mind. It could influence a little bit the Aussie here. But I want to show you this longer term chart because I think this is really important. If you don't follow me on Twitter, or you missed it on Twitter, if this flag or this this pennant starts playing out to the downside, notice how we take out new lows. Well, what's most important about that is if you go over to a weekly chart and you go to the COVID spike lows here, right, over to the lows back in 2022, then to where the flag or pennant would actually complete, that means it would take us right to that trend line, which would be a really, really in my opinion, probably a do or die level for the Aussie. But more importantly, the 64 cent level would probably be a good area for possible longs in the weeks ahead. So that's the way I'm kind of viewing the Aussie for right now. Out of Australia, there's no real, meaningful economic data. We have NAB business confidence on Monday. Well, it's actually Tuesday in Australia. Low is speaking from the RBA on Wednesday morning. But there's not a lot of economic data. There's going to be more in New Zealand with the RBNZ rate decision, which will be actually on Tuesday night or Wednesday morning if you're in New Zealand. But let's continue on with what you're seeing here in the Aussie. So Aussie, just realize we are back at the 200-day moving average. A lot of resistance up here around the 67 cent level. Keep that in mind. I also want to talk a little bit about the US dollar Japanese yen. We are seeing the US dollar Japanese yen really weaken at this point. Now, you'll notice that we're kind of in between fibs. I've tried to trade this thing on the short side. I am playing yen long through other currencies, which is fine. Totally enjoying my positions there. But I want to show you something here with the US dollar Japanese yen. Let me get rid of some of this stuff. I'm going to do a little bit of drawing for you. Okay, first and foremost, you can see how we broke that trend line. Big Marubozu closing candle. Very bearish following Friday's price action. Now, let me zoom back out here. If you take this and come all the way out this way, well, this is a kind of problematic actually as a whole, because you had an ascending wedge, kind of building. You broke out to the upside, but then you get a false breakout, and a false breakout usually leads, people get John G'd out there, and then, next thing you know, you get a reversal because everybody was chasing it higher. Now you got a really big reversal back down towards 138, 140. Now this is going to be a real big support level for the markets, in my opinion. We got the 50 DMA, but you got the 200 DMA and this big breakout point that's going to be really, really important on the way back down. Obviously, there's going to be support ahead of that. But as you guys probably know, the 145 level is kind of a do or die level for the market now. A lot of intervention talk has happened around there. So, where the BOJ and the Ministry of Finance are now, talking about, watching currency moves. So keep that in mind going into this next week as well. Now, another chart I want to go into before I talk about what's happening for the rest of the week and the equity markets that are, moving and things that we should be paying attention to. I wanted to take a look at the US dollar Mexican peso. Now, I've been building along down here around the $17 level for a couple of reasons. Well, first of all, if you go over to the weekly chart, you'll see it here. Let me draw it out for you. This is if you can't tell by eyeballing it, this is a head and shoulder pattern. Do you see it? Okay. More importantly, the 17 level is the neckline. But let me go ahead and delete that really quick. I'm going to show you something else. If you go from the 17, let's just do it like this, right, to where we first reached 17. Oh, I just totally screwed that one up. Here we go. All right, 17 right through here. You guys see it? Okay, let's move it over a little bit. Now, if you look at time and how long it took to build, this head and shoulder pattern, right? Yeah, there's your shoulder over here. So if that is your neckline and this is where we based at, that means time should take us out a few more months, before we, can actually make a bigger move lower. It should take us out a little bit more time if we are really going to, continue to build out a dollar Mexican peso head and shoulder top, which I believe we are actually doing. But because we're at where we're at 17, we're seeing a divergent relative strength. I think the risk is that you start bouncing around here, especially if we get some risk aversion. Now, you're probably thinking, well, Blake, we aren't seeing any risk aversion. Not yet, but you're already starting to see the bids really come in around the 17 level. So around the 17 level, I think we're going to be supported. I think you sell any move up towards 19 and a half up here, but that's really far from where we're at right now. And there's no real meaningful data coming out of Mexico next week. We have industrial production, I believe, that's coming out mid next week. But going back to the charts that I'm showing you, and I want to just be a little bit more specific about this chart. These are like long-term channels you might see down here. Long-term channels might be drawn like this, might be drawn like that. Just depends on, you know, what data feeds people are using. But what you're also going to notice is we have a descending wedge that is broken out to the upside. Now this wedge could spawn all the way back here as well. But however you want to look at it, we broke higher, and now we actually stopped where we should, well, you would assume, at 1744. 1742 to 1744, you can see how the sellers just lined up to get short right around that level, which is fine. But the reason why I bring this up is because, I don't even know why I'm on this video. There we go. All right. If we break above those levels, this is going to tell you that there's probably going to be some risk aversion hitting the market. And that is going to be important, because if the dollar Mexican peso, so hear what I have to say here. If the dollar Mexican peso breaks above 1744.45, I will be on the lookout for some risk aversion, because I'm gonna assume they're gonna be coinciding with one another at that point in time. All right, let me go ahead and get rid of myself there. All right, continuing on. So Sunday night we have, like I said, China CPI. China CPI, you know, I think the market's going to be watching it, but I think we need to also pay attention to the US dollar CNH. CNH. I need to check my spelling here. One of the reasons why I think the US dollar CNH is not CHF. There we go. One of the reasons why I think the US dollar CNH is a big deal is because, you know, this is a managed float by China. Now, why do you think China wants to keep, doesn't mind keeping the CNH weak? That's because they export a lot. And as much as China has tried to, you know, establish a middle class over the last 20 to 30 years, which they've done a great job. You think about the quality of life that Chinese people, how it's improved over the last 30 years, is because because China's done a great job in building out that middle class. However, is it strong enough to sustain their economy alone? No, they still have to export. They export everywhere, obviously. So if they feel that their economy is weakening, and they had a reopening and their economy is still sputtering because, you know, the United States and the rest of the world they're not importing enough, China needs to export more. So how do they export more? Well, they make their currency cheaper. So one of the things that I think we should be paying attention to is if we get a breakout of the US dollar CNH, especially above recent highs, and then we start taking out 735, 736, 740, whatever, however you want to look at it, that to me is going to signal that we should be thinking that China's economy is really, really weak, and they are trying to manage a much weaker yuan moving forward. So think about that, guys, because that's going to have a lot of implications to what you see in equity markets in the weeks and months ahead. Okay, I'm going to move on from the US dollar CNH. I'm going to talk a little bit about the cable, because we do have UK Jobs report that comes out actually Tuesday morning in the UK. So it's really, for me, it's like super late Thursday night. But take a look at the cable. I mean, we're right up against resistance. Why is this resistance so big? Why are we struggling so much at the 128.50 level? Can any of you answer that? Can any of you answer? If you can, jump down in the comments section below and tell me why we're struggling here at this level. I mean, it's a big resistance, obviously, for the cable. Well, I know I already got you typing already, but if you don't know this already, let's go over to the weekly chart and let's zoom out a little bit on the weekly chart, and you'll see high of 2021 to low of 2022. We are basically at roughly within, I don't know, what is that? 70 pips of the long-term weekly 618 retracement. And that low there, that's the low that I see on Forex.com's feed. But how about if ING sees a little bit lower price than that, or maybe a little bit higher price by OANDA? So it depends on what feed, or maybe the Bloomberg feed is a little off here. I don't have my Bloomberg subscription anymore, but look, we're within 100 pips of a long-term weekly 618 major fib level. So when you're talking about price and you're talking about levels, being around here within 100, 150 pips on a weekly basis, it's basically you're there. You're really struggling around this level. So we need to know that, and the reason why we should know that is because on Tuesday morning, the UK is going to have their jobs number, and is that a risk of possibly breaking out? I think a breakout above 128.50, 120, 129, it's going to be pretty bullish. I mean, there's not a lot of there's a lot of open air here. I mean, you start looking around. I mean, you start thinking, can we realistically make it to 130 to 131? Absolutely. Why couldn't we? I mean, channel resistance. Why can't we make it up there, especially on a big breakout? This is a big level. The next big weekly Fibonacci level doesn't come in until 134, 135. Now, do I believe that's going to happen? Not necessarily. I'm more constructive on the dollar because you see the big triangle that the euro's in. So I'm a little hesitant to be chasing the cable up here, but I think it's worth noting, right? And the FX market is not just the dollar. There's the euro sterling, which has been very weak and is on really key support. Maybe the sterling breaks out across the board against other currencies. Oh. All right, well, let's continue on. We have on Tuesday night, Tuesday night for me, but it's Wednesday morning, we have the RBNZ. All right, now I look at the Kiwi dollar, and this is kind of the same with the sterling. I look at it and I'm like, man, that's a big hot mess right there. Like, why would I want to get stuck trading that? By the way, if you're sitting there looking at this and you're eyeballing it and saying, oh, Blake, that's a head and shoulder pattern, my answer to you is no, it's not, because there is no arm for it to complete. So not correct. Okay, but if you're looking at that is a big hot mess. Why would I want to trade that? Well, I'm not going to bring your attention to that. I want to take your attention to the Aussie New Zealand. And let's pull up that currency pair really quick, and let's delete this stuff, and let me just show you something. So on the Aussie Kiwi, this is a 4-hour chart. If you go from the lows back here on May to the highs in June, we're at the 618 retracement. Now, what that tells you is if New Zealand, okay, they're supposed to hike rates by actually let me double check that. I thought they're set to hike rates. Oh no, they're going to keep rates. They're going to keep rates on. They're supposed to keep rates on hold. But how about if it's a hawkish hold, or if they do raise rates? Well, then that the Aussie Kiwi, a breakdown below these lows, is really bearish for the pair, very bullish for the Kiwi. Flip side is we did hold the 618, and if we see any New Zealand dollar weakness coming through the market following the RBNZ, then next thing you know, you're going to get a really nice reversal higher from here. So I think this is the pair to watch on Wednesday morning for the RBNZ rate decision. Now, speaking of Wednesday, let's talk about the US CPI. Let me delete this stuff here, and let's go to the dollar index. Let me find the dollar index. I don't know where it's at right at this moment in time, but I'll find one for you. Don't worry about that. There it is. Okay. So here's the dollar index. This is actually the triangle that I've been really focused on here with the dollar. Now, we could continue to break lower. This is a bearish consolidation. I mean, it really is. If you think about the move lower, we're just consolidating. So a miss on Wednesday, and we have producer prices on Thursday. A miss could really put the dollar index down towards these trend lows. But remember, this is a wedge. So when you're in a wedge and you're in the summer, right? this could happen, then down, and then eventually it breaks down, right? Eventually, at some point, it starts to break down. That would be the natural path of this technically. Now, again, I think it's a little early to identify that, but Wednesday's CPI data is going to be a big deal. You know what else is going to be a big deal on Wednesday? On Wednesday, another big deal is going to be the US dollar Canadian, because we have the Bank of Canada. Now, I want to talk about the US dollar Canadian because I think there's some conflicting signals here. I'm going to delete a few things. Let me delete. Well, no, before I do that. So, there's the 161% extension we actually had drawn out, right? We hit it. We bounced. Okay. Now that you've seen that, let's delete it, right? Okay. So now we bounced to the previous triangle, underside of that triangle, and really rejected it on Friday. Now, it was a big rejection on Friday because you had the U.S. and Canadian jobs report. So remember, we were talking about that. When you have a stronger Canadian number, which we did, you can see that headline number, big print, even though unemployment rate unexpectedly went up. Traders leaned into it. They sold dollars, bought Canadian dollars, and you saw a reversal there. Now, like I said, kind of conflicting reversal point, but you can see why it reversed where it did. The other thing is, let's go over to the weekly chart really quick of the dollar Canadian. The other thing you got to be thinking about is there's a lot of people that are stuck short, below the 133 level or 132. 132.20 level, and we closed our weekly candle above there. So that means if you're short, you need to be on notice. And the fact is if you break above 134, good chance is we're going to make it all the way back up to this 200-day and possibly even more than that. So I'd be looking at any move back above this week's high, this week being 133.85, 134. You break above that, I don't think you want to be short the US dollar Canadian anymore. Now remember, the BOC, the Bank of Canada, meets an hour and a half after the CPI data, and then an hour after that they have a press conference. Okay, so you should be noting that. Thursday morning, we have, we have US PPI. We also have UK GDP. It's backward looking, but still, let's see if the UK can, avoid a nasty recession. So the GDP numbers are going to matter to a lot of people. And then Friday, we have the University of Michigan consumer sentiment and inflation expectations numbers coming out as well. All right, I'm going to take you over to the equity markets really quick, and let's talk about the S&P and where we're currently at. So a couple weeks ago, we talked about being up near channel resistance. That's why I drew this box, right? And I'm like, oh, look, big, Garley pattern. Well, we reversed after that. Then I've been gone for the last, few weeks, right? Like 3 weeks, and we bounced right back to those highs. So it was a re-challenge of the 618 161% extension. But what that really suggests to me, and let me just show you something really quick. You see these highs right here? Whoop, I'm trying to draw that out, make it a different color. It'd be better if you can see it in a different color. Okay. Notice how we made new highs in price. Relative strength was very divergent. Okay, so after completing bull flag pattern, which we discussed, completing the 161% extension, now we got a double top risk. So if we break back below 4320 or 4300, however you want to look at it, but you can see there's a little, let me see if I can draw that for you. A little wedge right there, right? You can see that. After we broke out higher, now the risk is if you have a double top here and you break below these lows, now you're on pace to really challenge the 4200 level, which is, in my opinion, that's kind of the do or die level for equities. I mean, if you're long equities, all you really care about is 4200. I mean, yes, there's going to be some fluctuations around here. Yes, after making a move to 4400, 4450, there's a good chance that we can see a pullback to 4200, but 4200 would really need to hold. yeah, we could dip below it, but that's going to be really important. So if we have a double top that develops, if we head down to 4,200, then at 4,200, that's going to be the real litmus test for the market. So just keep that in mind in the weeks ahead. But I want to show you a couple charts that lead me to believe that we might actually start to see that. So the first one that I have to bring to your attention is going to be the DAX. Look at the DAX. We came out of an ascending wedge after hitting an all-time high, not 2023 highs like the S&P is at, or the NASDAQ was at, or the whatever else was at, but the German DAX hit an all-time high, but reversed. So when you get a false breakout, people get John G'd there, then next thing you know, you get reversals out of a wedge, retest of the wedge, previous support, current resistance. Now you get a move down towards the 200-day moving average. But if that happens, what do you think happens to other equity markets? This is a worldwide exchange. It's yes, this is the German DAX. Yes, it's going to be what's happening in Germany and the individual companies surrounding Germany is going to be more important, of course, but we still live in a global market. So if you start to see the German DAX really, sell off, and it's been leading, it's like been part of the leadership of global equities, then you need to start being careful if you own stocks in the S&P or the NASDAQ or hell, the Russell 2000, heaven forbid. Those are the things you need to be paying attention to. Also, take a look at the Nikkei. So the Nikkei 225, now I'm going to delete that, and I'm going to delete that, and I'm going to show you something. With the Nikkei, I'm not so convinced about just yet, and that was from a couple of weeks ago we talked about. That's why I just deleted that green line. We haven't looked at it since then, but you'll notice we're really on support here, right? And yeah, double top could lead to a move right back down to the breakout point below the 50 DMA. Now that's going to be, that's going to be important because that's going to be the highs back here in September 2021. And obviously it's going to be, it's not just, the Nikkei, it's, you got to see that divergent relative strength from a couple weeks ago. It's not just the Nikkei, you got to be watching the yen. Then, you think about the market in a form of dominoes. If you see the German DAX domino fall and you're long the S&P and you're like, I don't really want to be long the S&P anymore. Boom, that domino goes down. Then you look at the Nikkei and you're like, I've been holding Japanese stocks all year and I don't want that either. Boom, then that domino comes down, right? It's a domino effect in the markets that I think is going to be most important, especially when you have the leadership, the markets that have been leading the charge to highs this year are really starting to roll over before U.S. equities are. Now, so again, there's U.S. equities. They're starting to show signs of, weakness, and you can see it developing across the board. Last thing I'm gonna leave you with, because I know you want to see it, but I need to say, if you haven't tried out Forex Analytix, try it out. $1 for 10 days. Then you can jump in the community, be in our chats. You can be on the Morning Edge, which is our exclusive show. I've been doing the Morning Edge in one way, shape, or form literally for about 20 years now. I used to do it only audio broadcast when there was a 15-second delay, an internet delay. Like if you were listening to me in the UK and I was broadcasting from Dallas, Texas, which I was, it would have been a 15-second internet delay, and it was just audio. But we've been doing that show literally in one way, shape, or form, or I have, for the last 20 years. So if you want to be part of that, you want to be inside of our community, you want to communicate with myself, the rest of the team in Forex Analytix throughout the course of the day, because that's where we're at. If you want to be here in our chat rooms, and this is just the end of the week, just people having conversations at the end of the week. If you want to be in here and be in our trades room, know where we're getting in, buying and selling things, where I'm adding to Aussie exposure, the news and research room, you want to be in these places, $1 for 10 days. And another way you can take advantage of it is taking advantage of the trader funding program, because if you want to learn how to trade our money and not trade your own money, Well, check out the Trader Funding Program, because then you get included in the Forex Analytics community, because we want you to succeed. We want you to be trading and have ideas from, Ryan, Stelios, Steve, myself, Paulie, all the other Forex Analytics members, K-Man, traders inside of our community, having ideas, things to do, what to be trading, people to talk to like myself and say, hey, Blake, I'm struggling with, the S&P here. What do you think about it? That's why I'm there, to answer those questions. So you'll get that through the Trader Funding Program. So we try to make it as easy as possible for you to pass your assessment, no matter what account that you decide to choose, no matter if you want to access a $25,000 account or you want to access $1 million of our capital. Well, we want to be there for you. So that's why you should check out the Trader Funding Program. Okay, now I wanted to get into the last thing, which I want to talk a little bit about gold, because I think gold is important going into this next week. As gold, you have to factor into, let me pull it up. Gold, obviously, it goes into what happens with yields, what happens with the dollar, and with risk appetite, risk aversion, everything like that. So the reason why I bring this up is gold rejected 1935-ish, basically previous support. You can see it right here, right? Previous support, current resistance, current resistance, current resistance, current resistance. If we break that level, it's going to be really bullish. Now, I know a lot of you are like, I'm just going to lean bearish gold because we can't break back above that. So I'm just going to get short, and I'm looking for gold to move below this 161% extension right here. And once we break below that, I'm going to get really short and aggro short. Okay, I hear you. I hear what you're saying. And it's okay to be bearish gold. But what I want you to pay attention to before you get too bearish gold is, think about this. The dollar is pretty weak. And if the dollar continues to weaken, that could be, a headwind for gold bulls. So think about that, because I showed you the dollar index. It doesn't look great right now. Is there a lot of support around here? Yeah, of course there is. But does the dollar index look bullish? No, it doesn't. Not right now. So anyway, you think about that as far as gold goes. Also, I want you to watch this red trend line that we've been, watching for like literally months now. Okay. Trend line, retest, breakout, retest, hold, and now we're holding it. Now, if we do break 1895 or 1890 or whatever, the spot price is there, we start breaking those levels, I think gold will break down. And if gold is breaking down, that also might suggest that the dollar index is really catching a bid as well. So guys, gals, I want to thank you all for being here with me. And if you've enjoyed Ryan, Grega, make sure you give them a thumbs up. Tell them in the comments below. Jump in the comments below. Say, hey, I loved you guys' analysis. I'm sure they'd love to hear that. And also, if you have any comments for me, put them down in the comment section below. Guys, gals, thanks for being back with me. And I appreciate each and every one of you, almost. Thank you very much for being here. And I will catch you on Monday morning on the Free Face Show. Thank you. Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.